Welcome, friends. July 18th, the market update desk with Mortgage One. We're back in the Cabana office for the day, enjoying the slightly lower humidity out here, which is nice. Got a few things going on this morning. Uh, what we're seeing is jobless claims came out today. Both initial claims and continuing claims both were a little over 20,000 more than expected. So initial claims jumped to about 243,000. Continuing claims are inching closer and closer to 1.9 million. What that means is we've got more people filing for claims, and those that have claims are on it longer because the continuing claims continue to grow, which is a very big sign of employment weakness where people aren't finding jobs. Definitely in contrast to what you see in the media, because the media is not following the actual data, and of course, neither are the politicians. Where this is coming into play also is this week is a sample week again for the first week of August BLS jobs numbers for July. So this gives us some positive forward sight into what those jobless claims could be. And if those again come in weak, we're seeing more downward pressure on rates, and that's going to put more pressure on the Fed to lower rates. Once again, we're realistically probably not looking at a July rate cut on the 31st because there's only a 7% chance. But we're somewhere between a 97 and a 100% chance of a September rate cut. The biggest question is going to be, is it going to be a quarter point or is it going to be a half point? The continued slowdown of economy of what we're seeing and a weaker jobs market is putting a dual pressure on the Fed because they keep talking about their dual mandate with inflation and maximum employment. Also, we saw LEI today, leading economic indicators, come in weak. All this is showing us that we're on this runway. The question is when and how much of a rate cut we're going to get, and how that specifically is going to trickle down to mortgage rates. Keep in mind, these are not a specific correlation of a quarter point cut to the Fed rate or half point equals a quarter or half point cut to mortgage rates. These all are impacted by the bond market. We're trading in a very good range for the 10-year bond. If we can close one of these days below 4.15, that's going to give us a solid resistance level to work our way down to potentially 4.05 or even 4%, possibly sometime in August. So these are all great things. Refinancing is growing again. Talking to a lot of our customers about the benefit. Those that had over 7.25%, 7.5% rate over the last 12 months could definitely have a benefit, especially if that was an FHA loan or rural development loan that has mortgage insurance on it, or even conventional loan that had higher mortgage insurance because you had a smaller down payment. The increase in values, or meaning your equity, could give you a lower or no mortgage insurance component of your mortgage payment. That means a lower payment for you. Give us a call. We'll break down the numbers, use our knowledge for you to help you save money. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan, 616-293-2189. Have an awesome afternoon.